Hey everyone, welcome back to Corporate Decoder, the place where we crack open confusing financial reports to see if a company is really as healthy as it looks, or if it is just wearing a really good suit. In this latest report from Greene County Bancorp Incorporated, we've got some interesting numbers and strategies that might make you raise an eyebrow or two. So, what are we looking at today? It is Greene County Bancorp Incorporated's quarterly report, specifically for the period ending the 31st of December, 2025. Think of it as a financial checkup for the bank and its related businesses. Before we dive in, if you are tired of trying to decipher jargon-filled financial documents and want more of this kind of breakdown, hit that subscribe button and ring the notification bell. Also, we have a fantastic community over on Discord where we discuss these kinds of filings in real time, so come join us, the link is in the description below. Let's start by looking at the big picture, what the company owns and owes. At the end of December 2025, Greene County Bancorp had total assets of about $3.1 billion. That is up from around $3 billion back in June 2025. So the company has grown a little bit, adding about $106 million to its balance sheet. Now, where did that growth come from? A big chunk of it came from their investments. Their investments, the things they bought hoping to make a return on, went up significantly. Their securities available for sale and those held to maturity, which are essentially different ways of holding investments, jumped by almost $90 million, bringing their total to $1.2 billion. This is a pretty big part of their business, making up a substantial portion of everything they own. On the lending side, which is a bank's bread and butter, their net loans receivable also grew. They had about $1.7 billion in net loans at the end of 2025, up from roughly $1.6 billion in June. That is a $58.6 million increase, a solid 3.6% growth in the money they lent out. Now, what about the cash sitting around? Their cash and cash equivalents actually went down quite a bit. It dropped by about $59 million from $183 million down to $124 million. This isn't necessarily a bad thing. Banks often manage their cash levels very carefully. It could mean they deployed more cash into those growing loans and investments, or perhaps used it to manage other short-term needs. Let's dig a bit deeper into those investments. The company bought a lot of new securities. They spent about $460 million on purchases, mainly in US Treasuries and state and local government bonds. Why state and local bonds? Well, they mention it is to take advantage of tax savings and to support the communities where they operate. It also makes up a large part of their portfolio, about 57.8% of their entire securities holdings. That is a lot of eggs in one basket, even if it is a perceived safe one. Importantly, they stated that these mortgage-backed securities do not contain subprime loans, which is a good sign given the history of the financial markets. Looking at their loans, the biggest chunk, around 65%, is in commercial real estate. That means a lot of their money is tied up in office buildings, apartments, retail spaces, and construction projects. They also have a significant portion in residential real estate loans. It's definitely good to see their commercial real estate loans are mostly focused on non-owner occupied properties that are backed by cash flows and collateral, which is a safer approach generally. The weighted average loan to value ratio for these commercial real estate loans is around 57.7%, which is healthy. They also specifically called out their family housing loans, which make up 26.3% of their commercial real estate portfolio. This is a critical need in many areas and has historically performed well. They mentioned over 7% in construction loans, which can be risky, but they are actively monitoring these. Now, for any bank, the most crucial number to watch is how much they are setting aside for potential loan losses, their provision for credit losses. This shows how much they think they might lose from borrowers not paying back their loans. For the 3 months ending December 2025, they set aside $199,000 for this. For the 6-month period, it was $1.5 million. This number is actually quite low compared to their loan portfolio, which is generally a good sign, although it did increase. Let's talk about where the bank makes money besides just lending. Their non-interest income, which comes from things like service charges on deposit accounts and debit card fees, actually went down. For the 3 months ending December 2025, non-interest income decreased by a significant $719,000, mainly because they had a loss of $576,000 from selling some of their investment securities. That is a big hit. On the expense side, salaries and employee benefits went up. For the 3 months ending December 2025, this cost them $6.2 million, an increase of $570,000 compared to the previous year. This is a common trend indicating growth or rising labor costs. Other expenses like legal and professional fees also saw a substantial increase, jumping by more than 95% for the 3-month period. The core profitability of the bank, its net interest income, which is the difference between what they earn on loans and investments and what they pay on deposits, saw a big jump. For the 3 months ending December 2025, net interest income climbed to $19.1 million, up from $14.1 million the year before. That is a $5 million increase. A very strong performance driven by higher interest rates earned on their assets and a slight decrease in what they paid for deposits. This wider spread means more profit for the bank. What about the loans that are causing problems? Non-accrual loans, meaning loans where borrowers are struggling to pay, were about $3.3 million at the end of 2025. That is a very small percentage of their total loan portfolio. They also mentioned that their allowance for credit losses on loans covers these non-performing loans a whopping 654%. This indicates a very conservative approach to setting aside funds for bad loans. Let's look at where the bank gets its money. Their total deposits held steady at around $2.6 billion. They have a strong base of municipal deposits, making up almost 45% of their total deposits. This is a stable source of funding for them. They also have a significant amount of uninsured deposits, which are funds exceeding the FDIC insurance limit. However, they explain that a large portion of these are either collateralized or affiliate deposits, meaning the actual risk to the bank is much lower than the headline number might suggest. Banks have to maintain certain capital levels to be considered safe. Greene County Bancorp's banks are well above these requirements. For example, their total risk-based capital ratio was a solid 16.9% at the end of 2025, far exceeding the required 8%. This means they have a strong buffer to absorb potential losses. Overall assessment, so what is the story here? Greene County Bancorp Incorporated seems to be navigating a changing interest rate environment quite well, particularly with its net interest income showing strong growth. They've grown their loan and investment portfolios while managing their expenses, although the increase in salaries and legal fees are worth noting. Their focus on commercial real estate, especially multi-family housing, and their conservative approach to credit losses, including a very high coverage ratio for non-performing loans, are key strengths. The large municipal deposit base is a stable funding source, and their robust capital ratios provide significant safety. However, the dip in non-interest income, largely due to that loss on selling securities, and the rise in certain operating expenses are points to watch. They also have a substantial concentration in state and local government securities, which while often considered safe, still carry some risk. Lastly, the increased exposure to construction loans, while a small portion, always warrants careful monitoring. Overall, the company appears financially sound and strategically positioned, but like any financial institution, faces ongoing challenges in managing market risks and operational costs. That is our deep dive into Greene County Bancorp's latest financial report. What are your thoughts on their strategies and performance? Let us know in the comments below. If this video helped you understand these numbers better, give it a thumbs up. And for more corporate financial breakdowns, make sure you subscribe. And don't forget to join our Discord community, linked in the description. Thanks for watching, and we'll see you in the next one.